Hello, scholars. Today we are going to discuss few more points about mutual funds, and it will be useful for understanding as well as application. In the era of AI, everything can be done within a fraction of second. Even if you ask to find mutual fund analysis, it can be done very easily, but that will not give you clear understanding. And the importance of understanding is the confidence. Okay, if I tell you five mutual funds and if you start investing, that is very easy task, but you will not have the confidence when price goes down and market declines. It's like you cannot treat patients based on the chat gpt answer. Okay, so understanding might be a one time job, once in a lifetime. So I suggest that you understand subject in the learning phase as well as a learning phase. Thereafter you don't have to repeat the same thing. Basic concepts never changes. So this all the concept which we are discussing are the foundation which will be forever. Okay, so when we invest in the mutual funds, we have to have certain objective criterias to decide whether to invest or not. And that objective criteria are based on the comparison, to whom we should compare. So there are three parameters or benchmark we can compare. We can compare with the FD, because that is the easiest financial instrument where you can directly do investment. You know the risk status, how much is the risk or how much is the return. So we compare FD. It is also called as risk free return. Government bonds, alternative to FD is government bond. Both are for comparison purpose one and same. So when we talk about risk free return, it is usually government bond, but similar to government bond is a FD of the bank. Okay. Second, we can compare with the index or benchmark, for example, Nifty 50 or Nifty 500. That is benchmark whether your mutual fund, which is active mutual fund, which is performing better than index or not. That we have to see. And the peer group. For example, FlexiCap might have approximately 40 mutual funds. And then you want to select one out of 40. So you are comparing with the peer group. Okay, remember this three comparison. Comparison with the FD, whether your mutual fund is giving more than return than the FD 7%. Okay, if it is giving more than 7, 8, 9, 10, then only it is worth. Otherwise, if mutual fund gives return less than 5%, it is of no use. So first comparison with the FD return. For the return purpose, risk of FD is very less, but nevertheless, we always start with the FD return. Second, in the index, let's say Nifty 50 index gives 12%, and your mutual funds gives you 10%. Then what is the point of investing in active mutual funds? You can get directly to the passive mutual funds. So basically here we are comparing with the index funds or passive funds. Okay. And we are trying to understand the actively managed funds. Okay. So actively managed funds will be compared with the FD, it will be index funds and peer groups, the same groups. These are the three comparison. And then based on that, we want just one out of this 40. Okay. So comparison based measurement is necessary. I have shown this in a PPT. Today, I have again consolidated in a better way. You can take a snapshot and write it on the notebook. In fact, you write it down. Taking snapshot in mobile is not going to help too much. You have to write down on the notebook, and you do the mutual fund analysis. Whichever mutual fund you are investing, you can start analyzing. If you are not investing in mutual funds, which I am giving you some demo, or if you search any mutual funds on value research, start analysis of that mutual fund. So basic information here is the category, SEBI category. It is in the name itself. Then asset allocation, you have to find out how much equity, debt, and remaining cash, etc. So equity and debt is extremely important for that to decide a tax rate. We will discuss this tax rate in a separate video. There are three types of tax rate: equity tax rate, debt tax rate, and the M is for miscellaneous. That means whoever is not fitting in equity and whoever is not fitting into debt is put into miscellaneous. We'll discuss in detail later. Then basic information: mutual fund age should be more than 5 years. Asset under management should be more than 500. So this is the basic information of mutual funds. It is available on the value research. Now, this is the most crucial part or measurement objective part you have to understand and analyze. Remember the heading cost, risk stats, and return. Under the cost, this is the expense ratio. Our objective is to have the less expenses. Exit load, it should be low. Turnover should be low, because turnover means rapid churning of the portfolio can increase the cost. So this should be low. This is easily available when you click on the value research and click on the other, you get this information. Then when you click the risk stats, you get the standard deviation, you get the beta, you get the R square, you get the Sharpe ratio, shortage ratio, alpha information. Now, this is once in a lifetime learning. You better get start reading more about this. I'll try to explain some of them. Like I will explain Sortonis and alpha. You can read because Sortonis and Sharpies gives more or less same information, so it will be unnecessary repetition. But you can go ahead if you are curious. Understand Sharpies ratio. You can understand information ratio as well. Okay, we'll discuss this standard deviation, beta, and this is R square, that is correlation square. And our aim is to see this. I enumerated all parameter which should be low at the top and which parameter should be high at the bottom. Okay, so it will be easy to make the checklist. Now, how much high and how much low will be based on the comparison of the index and peer. Okay, there is no absolute number where we can say this standard deviation, this is low and this is high. It is based on the category and peer group. Nevertheless, we made one simple criteria that alpha should be at least 1. Okay, Shortness ratio should be at least 1. Exit load should be less than 1. Okay, however, there is no definition of low and high. Clear? This one is for the screening purpose, but it should be low. So high and low you understood from here. This is high category, high measurements, and these are low. Okay. In here you see that something is double. That means write down in R square, it should be low in the actively managed fund, but it should be high in the passively managed fund. Okay. Why? Because passively managed funds are tracking the index, and there has to be strong correlation only. This R square is nothing but the correlation square. Now, for practical purpose, even if you don't understand, you can easily start applying this algorithm, or we can say the protocols, that if mutual funds, you have, this should be the parameters. We will make a separate video on return, because this is a very important. Under the return, there are 3 types of return. One is called as CAGR, compound annual growth rate, XIR, that is extended internal rate of return, and rolling return. Okay, under the CAGR, there is a trailing return and point-to-point return. Under XIR, SIP return. Okay, if you check your mutual fund portfolio, you might get this return XIR, and this should be high. Okay, so if you want to if you want to become good intelligent investor, these terms are inevitable. You cannot invest without understanding this. You should not invest in a mutual fund without understanding this. Okay, because that will give you confidence and discipline. Okay, I need your cooperation, because it may not be possible to explain each parameter in a detail, because each parameter takes at least half day to explain. For example, how alpha is arrived, how XIR is calculated, and so on. But shortcut, I'll explain how it is calculated, and just for the understanding purpose, you don't have to calculate everything manually. Everything is already available. But how that Sharpies ratio is arrived, how Sortonage ratio arrived, that understanding will help you to get the confidence. There are 3 basic statistical terminologies. One is standard deviation, beta, and correlation. Based on standard deviation, there are 2 ratios: Sharpies ratio, Sortonage ratio. Based on the beta, we calculate alpha, and based on alpha, we calculate information ratio. As I mentioned at the beginning, this will look like a Greek and Latin, but once you understand, start applying frequently, it will be like very easy. Okay. And the based on the correlation R square. So these three are the basic statistics or basic concept, and these are related to the mutual fund only or any portfolio. So these are related to the portfolio, and these are the basic statistical concept. I suggest that everyone should be aware of this standard deviation correlation in investing. And even if you are a student, this will come into medicine in PSM statistic. If you are engineer, then you cannot run away without this understanding of this basic statistical concept. Okay. Now, when we invest into the stock, there are risk. Okay. You hear every day mutual funds are subject to market risk, and so on. So, what exactly the risks are? Okay. I use my own words to explain this risk. Okay, and I use layman's terms so that instead of complicated financial jargon. So first risk is pull down. Pull down means if you invest into mutual fund at 100 rupees and it has become now zero, this is full down. Now it full down risk is common in the stocks, but mutual fund cannot become zero because they invest into 40, 50 stocks. Full down's risk is not possible almost in mutual fund. Okay, what is full down? So this is a full down. This is the S Bank. 2019, it was trading around. This is a stock share price around 360. After the scam was exposed and all this, it has gone to almost 20 rupees. So it is 98% fall down. That is, we can consider a full down. So loss of entire money or loss of capital. This is the risk which everyone is scared of. That my entire capital can be wiped out in the stock market. This is the risk. Please note, this risk is not uh, applicable to the mutual funds, especially we diversified mutual fund. Write it down. Full down. That means you cannot lose entire money in the stock market. Usually, the people who lose money are not investing into the mutual funds. They are investing into the penny stock. That means really small stocks. They can become zero. Company close down and so on, and that become news. But real news of wealth creation never comes. So, but this is the full down risk in the stock which you should be aware. In mutual fund, it is not there. Second type of risk is drawdown. Okay, let's put this drawdown. What does that mean? Drawdown means now this is a Nifty index, and even mutual funds have the same pattern. So let's say in COVID, Nifty went around 12, 13,000, and then within 1 month dropped almost 30, 40% up to 7,500, and again started rising, again came to the previous level. This is called as drawdown. Drawdown means fall from a recent height to down and then coming back again. This percentage is called as drawdown. Okay. If stock falls like this and never comes to same level, then this is not called as drawdown. Drawdown has to be, it has to come again the same level. So that's why this is how it is understood. Drawdown means peak in the same level, and this is the bottom. So there should be a triangle formation, and from this line to this line is the drawdown. 30%, 40%, 50% drawdown. This is the real risk for the investor. That means sometime your portfolio may reduce to 30, 40, 50% as well. And you need a lot of patience to hold on so that you can again and see that Nifty went down, but it has gone almost double, tripled. Okay, this is the drawdown risk. Unfortunately, full down risk cannot be measured, or it is not practical to measure. Even drawdown risk, mutual fund managers usually don't mention it. We will show some drawdown, but this is measurable and real risk to the retailers. Okay, but day to day, what mutual funds managers talk about risk is this. This is day to day fluctuation. Actually, this is not relevant to the retail investors. because in mutual funds you are not interested day to day how 1% up 1% down. So let's say this is a closing price of Nifty. Here it went down, down, down. These are the prices. Okay, again one up, up, down, up, down. Similarly here, up, up, down. So we can calculate the daily change. How much is daily change? Now this is 1% daily change. Up, again down, again up, small up, small up, small up, again down, down. So this up and down, daily up and down is continuously, because market will, prices always fluctuate. And mutual fund manager and finance professional usually talk about this risk: daily fluctuation. Daily fluctuation is measured as a standard deviation of daily closing return or prices. Let me daily return. Return means daily change, and it is called as volatility. Okay, so write down. Volatility is annualized. Now this is annualized. I'll explain what is annualized as well. First, understand the definition of volatility. Volatility is the annualized standard deviation of daily return. There are three words: daily return, standard deviation of daily return, and annualized. And this is what they talk about risk. Finance professionals confuse investor by giving unnecessary information. I'm not talking wrong information, but redundant information. A lot of confusion to just create confusion. Real risk to mutual fund is not volatility day to day. It is real risk is drawdown. Okay. But since finance professional use the volatility standard deviation and that data is easily available for comparison, we are going to use the fluctuation of daily prices. Okay. So let me show one picture here, not picture, and explain how that is done. So write down, there are three types of risk. Full down, that means entire capital wiped out, which is less likely in the mutual fund. Drawdown, that means 30-40% price went down and again come up, that is drawdown. And third is the day-to-day fluctuation. Okay, so this is a Nifty daily prices, daily closing prices. You don't have to calculate this. Just understand, everything is already mentioned on the value research or everywhere. This is for only first time understanding and fundamentals. So how standard, and this is a statistical concept. Okay. So first step is calculating the volatility is to calculate the daily return. How it is calculated? Write it down. So second day price minus first day price divided by first day price and multiply by 100. This is daily change or daily return. Okay. This is what exactly it is done by using Excel. Let me calculate again in front of you. Second price minus first price. Okay. Then you can divide by first price and then multiply by 100. You got? And here, if you double click on this small arrow, you get entire information. So this is the daily return of these two dates. This is the daily return of these two dates. Okay, this is day 2. This is day 1, 2, 3, 4, 5, 6, 20 days data. Okay. For example, this, that means Nifty is minus 1.25% as compared to previous day. Here, Nifty is up by 0.6% as compared to previous day. Okay. So this will be 2 days information. This is second day minus first day divided by first day multiply by 100. So this is the daily return. So this is the daily return data. We will call this as xn observation in statistics. Okay. Then we calculate the average of daily return. Okay. This is average 0.22 minus 0.022% average. Next step is to calculate x minus mean. Okay, this is a statistical concept and very useful not only finance but everywhere. So I hope you pay attention to it. So these are the x values. This is the uh, return. Okay, average return. So then x minus mean. Okay, take it x minus mean. So this column represent x minus mean, which is the x. This is the x. Mean is this. X minus mean, x minus is a simple subtraction. Next step is to square this. Square of x minus 1. Okay, you take square and you see that now when we take the square, minus value, automatically minus sign is given because now it has become square. So this is the next step of doing the squares. Then take the average of squares. Average of squares. Okay, and when you take the square root of average of that square, you get a standard deviation. So the standard deviation is the deviation of daily return. Okay, I'll explain what does standard deviation means, but this is how calculated. We can directly calculate from the Excel formula, that is standard deviation P. Let's say here. So what I shown is the manual calculation or the basic fund, how it is calculated, but we can directly calculate by using this as well. So you get the same number. So this is standard deviation. This is daily standard deviation. Okay, this is a daily standard deviation. Clear? Whatever I shown is very important for the students who are in a, if you are learning for medicine or engineering. Standard deviation is extremely important concept in a statistic, without which you cannot learn the statistic mathematics. So here daily standard deviation got, you have the 0.73%. Okay, now it is annualized. For comparison purpose, it is annualized. How it is annualized? It is multiply by 19.1. You will say 19.1 कहाँ से आया? It is 365. 365 days. Square root of 365 is 19.1. So daily return is multiplied by the square root of whatever the days or time. And when we annualize means 1 year. So it is 19.1. Now please note in a bold, in books, YouTube, everywhere, they take square root of 252 days instead of 365. You may ask why they are taking 252. Because in a year, there are around 250 days, trading days. For Saturday, Sunday is holiday. So that's why they take 252. But for practical purpose and national stock exchange use 365. Okay. Statistically, or this is correct because there are only two, the number of days are not 365. But NSE use this 365. So we will also use 365 for practical purpose. So this is annualized standard deviation. Yesterday you saw that in a previous video, live session, you saw that video small cap mutual fund has 16% standardized standard deviation. Parak Parik had 8% and so on. This is the standard deviation. This is called as volatility. What is volatility? This is the volatility. Now let's talk about few things about why standard deviation and what does it support. So at least this calculation is understood how it is standard deviation calculated. Suppose these are the now next point. There are 20 returns. What I did is I sorted based on the largest to smallest to largest. Okay, so you see this is the minimum value. This is the maximum value. It is the same data which I just sorted. This is same data, X data. So this is the minimum value, minimum return. That means lower side return, and this is the higher side return. Suppose I ask you in last 20 days, how much is the range of return in which it is highest and lowest? So we can find out the range by maximum to minimum. This is the range of different observation. Okay, but in statistics, this range is rarely used because sometime, suppose this number is suddenly 10, then range will be, even single value can change this range significantly. You can see this. Now take one example. If we say that there are 100 people, 100 friends in the 100 friends in the batch, and you take a income of everyone. So lowest person has, let's say, 10 lakh annual income, and highest has maybe some 50 lakh 50 lakhs income annually. And then if someone comes, someone has become like entrepreneur, like Bill Gates, and if you add one which has billions, so you cannot say that 101%, 101 students, the range is between 10 lakhs to 10 billion, because one single number can distort the entire picture. So that's why standard deviation picture into come into picture, where this data is considered as 100%, and the central 68% data fall from average to one standard deviation on upside and on downside. Then two standard deviation data falls in the 95% data fall in two standard deviation. That means average plus minus two standard deviation. So standard, write down, standard deviation is the measure of data dispersion. Okay, that is, it's a measure of data dispersion, full stop. It can also suggest the range of the data. One standard deviation range is one standard deviation data will have the 68% data in that range. Let's say here, now let me check here now. How much is the standard deviation here? 7.3. Average is 0.22. Okay, so this was the average, and this was the standard deviation. So here, okay, so one standard deviation range is average plus, this will be upside, and average minus standard deviation. Yes. So in this range, 95% data will fall. Where is it now? We can see, find the range. Now this, not 95, 68. So we can say this up to here. 68% of data will fall in one standard deviation range. Okay. Now, if you want to find two standard deviation range, so upside will be average. Okay. Now, if you want to find two standard deviation range, so upside will be percent. So we can say 0.22. Okay. So this was the average, and this was the standard deviation. So here, okay. So one standard deviation range is average plus, this will be upside, and average minus standard deviation. Yes. So in this range, 95% data will fall. Where is it now? We can see find the range. Now this, not 95, 68%. So we can see this up to here. 68% of data will fall in one standard deviation range. Okay. Now, if you want to find two standard deviation range, so upside will be average plus 2 multiply by standard deviation. This will be upside, and lower will be average minus 2 into standard deviation. So this will be the, it will have 95% data between this. Now you can see that 1.24 here, okay, to 1.69. Okay, so now this is covering almost 95% data. Now this is a very small data. If you take the huge data, then you will see the exit. Now it is covering entire thing, but this is the concept. If three standard deviation is taken, then 99% data will be covered. Okay, this is the concept of standard deviation and volatility. Okay, now let's go how standard deviation is used for the short-tonnage ratio and sharpage ratio. So what is standard deviation? Now you understood standard deviation. Standard deviation is the annualized standard deviation of daily closing price, daily return. Okay. Now sharpage ratio takes portfolio return. Suppose portfolio given and the FD return, it is called as risk-free return, and then standard deviation. This is the ratio of the sharpage. For example, one portfolio give 14%, FD return is 6%. Okay. And then if one stock has standard deviation of 12, now you'll see that 8 divided by 12. So short-tonnage ratio is sharpage ratio is less than 1. Okay. Suppose mutual fund has 24% return. Sharpage ratio become 1.5. This is sharpage ratio. To increase the sharpage ratio, portfolio return should increase, or else standard deviation should low. Then only sharpage ratio will go up. But we are not taking sharpage ratio here. We are taking the shortenage. Shortenage. What is that shortenage? Here, standard deviation is the total deviation of all the return. In case of shortenage ratio, this is the same. I'll put same here so that, but the denominator is downside deviation. Rest is same. What is same? Numerator. This is for shortenage. These are the name of people. Sharpie, Sortoni. So shortenage ratio is portfolio return divided by risk-free return divided by downside deviation. Now, what is downside deviation? Let's focus. I'll explain the here. So here, what we took was the standard deviation of all the observation. Okay, this 73 was the observation. But what if we take only the return which were negative or below average? Okay, so let's start writing here. Condition if this return is less than this, I'll take below average. Okay, then this, or else 0. Now this is okay. So what we have taken here now, only the return which are below average, they are taken here for calculation, which are below average. Above average, we are not taking them. And then take the standard deviation of all this data. Please don't get scared. This, you don't have to do it. It's just understanding purpose. Now you use this standard deviation for the calculation purpose. Here it was 0.7373, and this is a downside deviation. It is standard deviation only, but only the negative side. And this was entire data. So that is the reason short-noise ratio will be always more than the sharpish, because downside will be have the less number. Okay. Why don't we take both? Because it is not required. It gives one and same information. The only difference between sharpish and short-noise ratio is that short-noise ratio take the deviation only downside. Upside is not taken into consideration. Okay. So this is standard deviation, sharpish, and shortening. Okay. This. So today we finished standard deviation, sharpish ratio, shortening ratio. Now, when we look at the mutual fund, we need mutual fund which has a less standard deviation. And you know the denominator here is the standard deviation. So we need more sharpish and shortening ratio. Okay. So this is a basic understanding of risk and how risk is measured. Risk is measured by standard deviation, but it is not a real risk of the retailers. Okay. I am repeating again. This is finance professionals gives misinformation to the retailers, uh, and they get confused because this is not related to the retailers are not worried about day-to-day fluctuation. Real risk in finance or investing is this two one, first and second, where your entire capital get wiped out, and second, portfolio goes significantly down. This is called as drawdown risk. So write in your notebook, drawdown risk is more important for the retailers, and read more about it. So may watch chat gpt, watch videos, because this is the real risk you are going to face. This is just for the comparison purpose. This is not the real risk for the retailer. This is not related to the mutual funds, because your portfolio is diversified and all stocks cannot become zero. But learn more about this, and this is just for the comparison and understanding what finance professionals are talking about. All right. Thank you very much. I need your cooperation to learn, and watch this video every day. You can watch twice, thrice, and write down the notes, because this video will be available for limited period of time. Thank you very much.